Good evening, everyone. We want to welcome all of you to our first educator-focused seminar offered by our new investment advisory partner, TCG Advisors. We're excited to bring this timely information to you in what has certainly been a unique year on many fronts. We are equally excited about partnering with TCG to provide you with an investment advisory firm that provides quality information and advice to help you achieve your investment objectives. Firstmark selected TCG as our partner because of their expertise, as well as their focus on serving our members in a fiduciary capacity, which means they always act in your best interest. TCG has been widely recognized as a top financial advisory firm by top financial publications such as Forbes and the Financial Times. They offer a broad range of services to members from a variety of backgrounds, and they also have deep experience working with school districts and their employees to provide expertise on TRS, as well as 403B and 457B investment accounts. Our presenters today are Matt Escalante and Justin Fellers. Matt Escalante is a partner and senior director of institutional investment initiatives at TCG. In his current role, Matt is responsible for working closely with clients to develop retirement planning education and engagement activities for their employees. Matt received his BA in business management from California State University, Fullerton. He also holds Series 6 and Series 63 FINRA securities licenses as well, and is also a certified financial planner. Justin Fellers is a senior retirement plan specialist at TCG. Justin works closely with clients to review their financial situation, provides investment guidance, and counsels individuals on how to create a plan to meet their retirement goals. Justin is a graduate of Texas A&M University, Texarkana, where he earned his Master's of Business Administration alongside finance and accounting concentrations. I'm sure our participants will have questions for each of you at the end of your presentation. So without further delay, I'm pleased to hand the program over to Matt and Justin.
Thanks a lot, Greg. I mean, we're really excited to have this presentation for everybody today, provide the information and the content, and of course, partner with a quality organization like Firstmark Credit Union. With that being said, we'd be happy to jump into the content and give you some more information about this educator-focused retirement concept that we think is really important, and hopefully we can provide some impactful information on everybody's personal finance so that they can get a feeling of reducing some financial stress and having a good path forward towards their retirement goals. Starting with just a little bit more about TCG, we operate in a few capacities. One as a plan administrator, so that when you're participating in a group retirement plan, take care of the actually enrollment process, but then on the back end, the compliance, the distributions, and those types of items. We also act, as Greg mentioned, as the advisor to the plan. So doing evaluation of the underlying investment options that employees have to choose from, and just making sure that they're of the highest quality and lowest cost. And then finally, as a consulting firm, work to make sure that we're meeting those fiduciary obligations of the employer and the firm to make sure that the whole thing works together so that employees are having the best product and retirement outcome possible. Because we know that retirement is only one area of personal finance, TCG a few years ago did launch the FinPath Financial Wellness Program that also focuses on just really a wide variety of areas of personal finance where folks may need support. So with all of that, we have the privilege of working with over 800 active plans. Most of those are in the K-12 space, so school districts primarily in Texas, where TCG is also located. We have $3.6 billion under management and over $10 billion under administration. So we have an opportunity to work with a lot of school district employees throughout the year, have a lot of conversations, and had really thoughtfully designed this presentation based off a lot of the feedback and questions that we get. Some of the biggest advantages of working with TCG are that, one, we're a fiduciary, as Greg mentioned, so always keeping our clients' best interest in mind. But also we're an independent fee-based organization. So when we're sitting with an individual and we're talking about investment solutions, we don't get paid by those organizations we work for our clients, and that's either the employer or the employee. So jumping into the content here is really this first topic that I want to cover with you is this concept of the retirement income gap. And this is not necessarily unique to those in K-12, but it does have some unique characteristics that I want to walk through with you. Basically, the retirement income gap is this concept between the difference between your last paycheck as a full-time employee of your school district, then you make that transition to retirement, and now your first paycheck as a full-time retiree getting your income stream from the TRS system. So just understanding what that transition looks like kind of develops what we call this retirement income gap. So if we're looking at retirement, it's important to distinguish that the retirement of an educator is going to look different than that of your neighbor, unless your neighbor happens to also be in education as well. But for example, somebody like me that's in the financial advisory service, my retirement is going to look a lot different than yours. So on the bottom left, we can see that if we're an educator that's been in the TRS system for a long period of time, for the majority of our career, my assumption here is let's say about 30 years of service. We can see in the dark blue that the majority of your retirement income is probably going to come from the TRS system. Now, there may or may not be some level of Social Security, that little sliver there, and we'll spend some time on that. But then the rest of your retirement income is going to come from your own personal savings into 403Bs, 457s, brokerage accounts, IRAs, CDs, like all these money under your mattress, wherever you choose to save money for future goals. Now that looks a lot different than that on the right, that of your neighbor who's not in K-12 in Texas. You can see that the majority of their retirement income is going to come from their own personal savings into their 401k or IRAs or brokerage accounts or all those account types that we talked about earlier. And then that's going to be rounded out by some level of Social Security making up the remainder of it. So you can see that they're pretty different with having the majority coming from TRS versus from own personal savings. What I hope that stands out to you is that, if we're looking at this and we see that the majority of your retirement income potentially comes from TRS, then we should be doing everything that we can to understand it, nurture it, maximize it, so we can get the most out of our retirement goals. TRS is fully aware of this concept of the retirement income gap, and they want you to have really the most successful retirement as possible. And back in 2016, they put together this video series, this financial awareness video series that I think is really beneficial. There's a lot of content out there about retirement savings and pensions and Social Security, but this is actually put out by the folks that control your pension. So it's pretty good stuff. It ties everything together. There's probably about 15 or 20 different videos, but it covers these kind of core topics of what you have in your pension and understanding that what you need. So this concept of understanding when I go to retire, I'm going to need to have some level of monthly income to support myself during my retirement years. And of course, then how to get it is going through that process of making that transition into retirement and receiving that payment that we'll talk about coming from the TRS system. So here we start to understand the TRS formula, and TRS is a major financial institution managing billions of dollars with really complex investment strategies, stocks, bonds, private equity, all these types of things. But luckily for us, the formula is very simple and straightforward. We have it across your screen there in the gray box. All we have to know about ourselves is 3 simple numbers and be able to multiply them together. So the first one is we just need to know how many years of service we have in the TRS system. And that could be for multiple school districts or for a single school district, doesn't really matter, but we just need to know how many years of service that we have. We take that and we multiply that by the state factor of 2.3%. And 2.3% remains the same whether it's our 5th year or our 50th year, we're still going to use 2.3%. Then we take that and we multiply it by the average of either our 3 or 5 highest years of income. And it's going to be 3 or 5 depending on when you enter the system. Those that are the average of 3 are considered grandfathered. Those are the average of 5 are considered non-grandfathered in TRS terms. And folks that have been in the system for longer periods of time, they tend to be the average of 3. You would prefer to be the average of 3. You don't really have a say in it necessarily. But those that have the average of 3 highest salaries, is typically more beneficial because you have, if you have 5, you have 2 lower salaries that go into that average. But if you're in a situation where you don't know whether you're grandfathered or not, 3 or 5, then I recommend please checking your TRS statement. And your TRS statement will show you when they're giving you the estimates, whether you're averaging your 3 highest salaries, that would be grandfathered, or your 5 highest salaries, that would be considered non-grandfathered. Multiply those numbers together, and that'll give us our maximum benefit, which will be the lifetime income for that of the retiree. And we have a slide on survivor benefits as well. So we'll talk about how do we take care of our spouse and dependents. So I have a quick example. You see there on the bottom left, and this is just an example. Please apply your own numbers to the formula to get a rough estimate of where you currently stand. But in my example here, we have somebody with 30 years of service. We multiply that by the state factor of 2.3%. Well, that's going to give us 69% of final comp. If our average of either 3 or 5 is $60,000, well, then 69% of $60,000 is $41,400. And $41,400 in my example is going to be basically that retirement income for this individual. On the right-hand side, we see that graphically where somebody starts their career, their income goes up because either they have a pay increase or maybe they're changing positions. In my example, this individual retires at age 60. We apply the TRS formula. Again, we go from making $60,000 to making $41,400, which is a 31% net loss of gross income. And that reduction then is basically the illustration of our retirement income gap. So this is important for a few reasons. Two that kind of come to mind that are most important is one, nobody wants to go into their retirement years having taken a cut in pay. You worked really hard. You don't want to have to negotiate and compromise. So you don't want to necessarily have to take that cut if you don't have additional savings or Social Security to supplement that. Ideally, you'd like to get as close to 100% of your income going to retirement so you can really enjoy those years as much as possible. The other major reason is that TRS does not have a cost of living adjustment built into it. So that, if you retired at age 60 making $41,400, you would be making the same amount at age 70 and at age 80 and at age 90 and so forth because there's no cost of living adjustment. So how do we maximize our TRS? Well, the first thing that we do is we walk into our boss's office tomorrow morning and we say, I need a salary increase, right? Because we know that salary is one of the main factors that goes into the TRS formula. So good luck with that. But if we know that salary is one way to affect it, we also know that years of service in the system can affect it as well. So do we have some opportunities in front of us to increase years of service? Well, the main way is obviously work another year, continue to work. Working more years will add to our total years of service in the system. The second way is potentially purchasing service credit into the system. There used to have the ability to purchase what we refer to as unearned service credit, meaning that you never worked one of those days, but if you had enough money, you could then pay for a year of service through writing a check or taking the money out of your retirement account or whatever it is. That was a deal that got shut off here just a handful of years back. So you don't have that option anymore. But you do have some other options ahead of you in getting more service credit. One is if you're somebody that has withdrawn service in the past. Maybe you started your career in education, but you left. And when you left, you cashed out those years, you rolled that money over into a retirement account. Maybe you just took a withdrawal, whatever it might be. When you come back into the system, you can purchase those years back. Just know that it's going to be a little bit more expensive because you're a little bit older and you're probably making a little bit more money than you were when you initially started. If you're from out of state, if you worked in Chicago or Illinois, or if you worked in New York, California, Florida, wherever these places are, and you have now come into the system, you can purchase those years from the other teachers' retirement systems in those other states and move them into the TRS system here in Texas. If you're military, you can purchase service credit. If you have any unreported service credit, you're a substitute. There's a variety of ways where you can add to your service credit, which may be worth it when you're looking at, again, increasing that monthly payment from the pension system. So when we come into the TRS system and we look at what is our criteria, when do we become eligible to retire from the system, is TRS has us lumped into basically one of 6 tiers. The first 2 tiers, tiers 1 and 2, these are for folks that have been in the system for the longest period of time. Your tier 1, if your membership began prior to September 1 of 2007, and you had at least 5 years of service by August 31st of 2014. If you're tier 1 or tier 2, then the simple criteria for you to retire is you have to have at least 5 years of service, because that's what gets you vested, and then you have to meet the rule of 80. And the rule of 80 is really simple. It's basically you take your age plus your years of service. Anytime you add those numbers together and they equal 80, that's when you are eligible to retire. So we see a lot of people that we meet with that are in their, at this point, their early to mid 50s, that maybe started in an education role in K-12 right out of college and are in their earlier mid 50s, and they're meeting the rule of 80. Now, they're eligible to retire from the system. It doesn't necessarily mean that they should retire. That becomes a planning decision at that point in time. But remember, since we know the formula, we know that for every year that we work, we're increasing our retirement payout by 2.3%, that factor. So TRS makes a change. They introduced tiers 3 and 4, and folks in 3 or 4 came into the system between September 1 of 2007 and August 31st of 2014. Still the same basic retirement criteria apply, that you have at least 5 years of service, you have to meet that rule of 80, but now there's a minimum age requirement where you have to be at least age 60 to have a full retirement out of the system. So tiers 3 and 4, I should say, have this minimum age requirement in place. TRS system meets again. They introduced tiers 5 and 6. These folks began their membership on or after September 1 of 2014. Same type of deal. Have at least 5 years of service to be vested, have to have met the rule of 80, and these folks also have to achieve a minimum age of 62. So what I hope it's standing out to you, and I think is really important to kind of pause and reflect on, is that the TRS system is fantastic. We think it's incredible, especially here in Texas, probably one of, if not the best in the country. So you have that. And, Justin and I would probably gladly trade you our Social Security for your TRS pension any day if we could, all joking aside. But, what's important to notice is that if we're looking at that difference between being grandfathered and non-grandfathered, the difference between being tier 1 versus being tier 6, we can see that they're not doing a whole lot to make the system better, especially for those people that are coming in. So that's why it's really important to understand these rules and these criteria and the legislation and all this stuff, so that we can be having this planning conversation now and preparing ourselves for our future goals. When we went through our example of going from $60,000 a year to $41,400, we talked about that $41,400 representing the maximum benefit, and that's basically the TRS system saying that we will pay out that dollar amount for the remainder of the life expectancy for that individual, the retiree. And that's what we call the standard annuity, as it's displayed here on your screen. So that'll continue to pay out until the retiree passes away. Well, that doesn't work for everybody. We have spouses, we have dependents, we have folks that we need to take care of. So TRS does supply you with 5 different survivor benefit options that you can choose from in order to leave a benefit for, again, a spouse or a dependent, whoever it might be. Now, 1, 2, and 5 are very similar to where you can see their percentages of income replacement. So a good example here is if I chose option 1, is basically what's going to happen is they're going to take my standard annuity amount, so my $41,400 in my example, they're going to reduce it by some percentage. Typically, it's around 8 to 13%. And there's a range there because if your spouse is younger than you, you're going to get a higher percentage because the actuaries are going to look at this and say, well, that younger spouse is potentially going to live for a longer period of time. Therefore, we're going to have to pay that individual out for a longer period of time. But by choosing the survivor benefit option, we're now shifting from a single life expectancy, that of the retiree, to now 2 life expectancies, that of the retiree and the spouse. So that's going to cost us a little bit in the form of this reduction. So if I chose option 1, I would get the largest potential reduction. Option 1, by the way, is also the most popular because it's probably the most conservative and most secure if you're looking at a retirement income planning picture. But in option 1, if we went from $41,400, which is our standard annuity amount, we took a reduced amount and the retiree passed away, basically it's saying that 100% of what we were getting paid as when we were both alive will continue on to my spouse if I, the retiree, predecease my spouse. Options 5 and 2 are just variations of that. So I can take a lesser reduction upfront if I chose let's say option 2, but only 50% of what we were getting paid together would continue on to my spouse. So there would be a reduced amount that would continue on to my spouse and so forth. So it's important to understand what are our retirement income needs when we're together in retirement versus if something happens, what is the retirement needs of my spouse if I pass away? So another planning point. Options 3 and 4 are a little bit different. Now we're shifting the basically the formula here off of, on options 1, 2, and 5, that was based off the participant's life expectancy, which is a little bit unknown on how long somebody is potentially going to live. Now we're shifting the focus on fixed periods of time, either 60 months or 120 months. Now, because the fixed periods of time are much more friendly to the actuaries, they'll give you a much lesser reduction, but there's only going to be a survivor benefit for, again, that fixed period of time. So for example, if we chose option 3, the 60-month period certain, and I was the retiree, and let's say 20 months into retirement, I happened to pass away, only the remaining 40 months would continue on to my beneficiary. So really important if we're choosing the period certain to know that we have this need that we have to cover for a specific period of time. And with that, I'm going to pass it on to Justin to talk about some of the retirement savings tools that you have to help bridge this retirement income gap.
Thank you, Matt. So now that we've gone over kind of how TRS works and how much you might receive and how much your income gap might be, let's talk about some of the tools that you have for savings that might help you close that gap. So if you'll see here, there's obviously tax-deferred savings plans. We have our employer-sponsored savings plans, which in the education space is going to be our 403B and 457. And then we have individual plan types as well, the traditional IRA and Roth IRA. Some of you may also save in other areas such as rental property, or you have a business or something like that. But today we're going to focus a little bit more on the employer-sponsored options, the 403B and 457. So when we think about the 403B and 457, most of us are familiar with a 401k, which is going to be for like those in the private sector like me and Matt. However, a 403B was created for nonprofits, and a 457 was created for governmental agencies. So the first question I normally get is, why do I have 2 plans? Well, when you work in the education space at a school district, you're kind of a hybrid nonprofit governmental agency. So that's why you have these 2 plans available to you. The second question I normally get is, which plan is better? And the fact is, neither one of these plans is really better than the other. If someone tells you that one plan is better than the other, it's probably just because they're trying to sell you their plan because they get a commission or something like that. But at the end of the day, what's going to be most important to you is What are the fees that you are paying for the plan relative to the returns and level of service that you are getting? So if you look at this comparison that we have here, you'll notice that the plans are very, very similar. They have the same contribution limits, virtually the same access to funds. However, there are a couple of differences. So when we look at the penalty to withdraw funds in the 403B, once you leave your employer, you're qualified to take those funds out. Not that it's recommended to do so, but you can. If you are under the age of 59 and a half, or if you're under the age of 59 and a half, and you're not retired and 55 years of age, there is a 10% penalty that you will have to pay, just like with a 401k or an IRA. The 457, however, does not have this penalty no matter what age you are. Now, you still may have to pay taxes if you made pre-tax contributions, and we'll talk about that in a little bit. However, there is not a penalty to withdraw those funds. Also, since the 403B space is in the nonprofit space, you generally are going to have a lot of different options or a lot of different investment providers for that particular plan. And they all have different fee structures. Some of them charge commissions or sales loads. Most of the time, there's a limited number of non-commission options. The 457 can be that way, but generally, you're going to have less investment provider options. A lot of them are going to be lower fees relative to the 403B plans. Most of them don't charge commissions, and you can get a full disclosure of those fees. So the next topic that I want to go over is ROTH. So we all have heard about, or generally our contributions that we know that we make into our savings plans are pre-tax contributions. And that means that when you make that contribution and it goes into the account, you don't have to pay taxes on that money in the year you make the contribution. So you get a tax break. However, when those funds come out in retirement, you pay ordinary income taxes at that point on every dollar that comes out. So what is ROTH? Well, a lot of us have that misconception that ROTH is an account. And actually, ROTH is a tax treatment of your contributions and distributions. So it works opposite of a pre-tax contribution. So what that means is you get your check, taxes are taken out of it, and after that, after-tax money is placed into the account. So you've already paid taxes on those funds. So that money grows inside of the account, tax-free, and then when you take that money out in retirement, you don't owe any taxes on anything that comes out, including the growth. So there's a common perception that this is just for an IRA. However, this can be used in 403Bs, 457Bs, and 401Ks, but not all plans are eligible. So you would need to check with your specific employer or school district to see if you have that option in both of the plans. Our next topic today is going to be on some of the basics of investing. So whenever you choose one of your savings plans, whether that's an IRA, 403B, or 457, there's conservative investment options and there's aggressive investment options. And in some of those options, you will probably be invested in the market. So if we take a look at this chart right here, this is going to be an example of someone who is investing $200 a month into their plan. And this chart looks great, right? I mean, we want all of our investments to do this. We start off and the price of our investments just increases and increases and increases. Now, obviously this doesn't happen all the time, but let's just go through this example. So in January, in our example on the right-hand side, we make our $200 contribution. Our $200 is able to buy 20 shares because our shares are currently priced at $10 a share. And if you'll see as we move on down, all the way to June, July, August, September, all the way through to November, the price of our shares has been increasing this whole time, which is a great situation to be in. However, at this point, our same $200 is now able to purchase 13.33 shares. So still in a great situation. So if we take a look at the end of this scenario, you'll notice that you own about a little less than 180 shares with a total account value of $2,683.48. So this is a great situation, but let's take a look at a more realistic situation and one that more recently happened when the virus came up and the stock market, you probably have heard, oh, the stock market was crashing, it started going down, and it did come right back up. So this is a great example and a great chart of what's happened recently. So in this example, we start off with our same $200 in January. Shares are $10 a share. We got our 20 shares. But if you'll notice, from February all the way down to June, the stock market has started to go down. And now the price of the shares has been cut in half to $5 a share. So if you're contributing to a retirement plan or to an investment at this point, this is actually going to be a good situation. So if you'll notice, your same $200 that was able to purchase 20 shares in January, now in June, you're able to purchase 40 shares. So if you'll see in July, the price of our shares starts to rise all the way through to November until it gets back up, and now great, we've just broken even. However, let's look a little bit closer here. If you'll notice in this example, you now own a total amount of shares of just under 300 shares, and your total account value is now $2,982.54. This is an 11% increase from the previous example. So I show you all this and demonstrate this just so that you can get an idea of the stock market's always going to go up and down. However, there is not a time in history where the market has gone down and it has not come back up to where it was and gone even higher. We've just experienced this recently. But the really important thing to note here is throughout this whole situation, you were purchasing shares and you never made a sale. So you only actually lose that money whenever you make a sale. So when we're contributing to our retirement plans, you should actually be excited when the market goes down and realize that you're getting these shares on sale at a discount. So when it does come back up like it has every single time, you're going to be in a better situation. So our next topic, let's watch out for your best interest. So what do I mean by that? So there's a few things to look out for. Whenever you're looking to invest in your 403b, your 457, or an IRA, there's fees for investing in those types of accounts. You may hear someone tell you that their account is free or they're not charging a fee on that account. Well, obviously this can't be true. But how could they be explaining this, or how could they be saying this to you? So one way this could happen is someone could take your money and invest it and earn 6% themselves, but then they pay you 2%. So while they may tell you that there's no fee, you're really losing that 4%, and that's the fee. So just a red flag to know if someone tells you that the account does not have a fee, that is not true. There is a fee somewhere, and we're going to talk about those fees a little bit more on another slide. So next, pension maximization. So what this says, your TRS is a pension. And whenever you take that beneficiary option, obviously it decreases that monthly benefit a little bit. So you may have someone or an advisor or a friend or someone tell you, you know what, you should maximize that pension, take the full amount, don't add the beneficiary option, and go purchase an option for like life insurance or something else like that for your beneficiaries. However, what they're not understanding is the TRS pension, if that gets paid out, like if you take that 100% that goes onto the beneficiary like Matt talked about, that is a guaranteed lifetime payment to your beneficiary. So if you're receiving, in that example, $41,000 a year, to be able to purchase an investment like that pays that out to your beneficiary would be hundreds of thousands of dollars. So just something to look out for if you hear someone asking you to not use that beneficiary option. The next thing is going to be take a lump sum, invest, and beat the state. So what do I mean by that? Well, whenever it comes time for you to take that TRS pension, some of you may have the option to take a partial lump sum, meaning you may have the option to take 1, 2, or 3 years of those payments up front in a lump sum. Now, why would you do that? Is that a good idea? So on the next slide here, we're going to talk about some possible reasons that you should do that and possible reasons that you should not. But let me go ahead and say, in most instances, this is generally not a good idea. So what are some reasons that you might do this? Well, maybe you're in poor health and you're worried that, once you pass away, that pension stops and it's not going to be paid out. So maybe you want some funds that you want to pass on to your heirs or to someone else. And that is a way to have that happen, because whenever that pension stops, if you don't have a beneficiary, it goes away. Or once that beneficiary passes away, that will go away. So maybe you don't have any savings going into retirement. Maybe you have some credit card debt that's pretty high at really high interest rates of 20% or something like that. That could be a reason to do that partial lump sum. But you would definitely want to reach out to us before taking that option to let us help you figure out if it really makes sense for your situation. There's generally on the right-hand side here more reasons not to do. And the main reason for this is you're not going to be able to take and invest that money to beat the state retirement system. You may have an advisor or someone tell you to take that money out and we'll invest it and we'll grow it more than we can. Well, that advisor is going to have to earn 11% compounded annually with no risk to do that. There is not an advisor or a company in the world that is going to get you 11% with no risk. It's just not going to happen. So that's one of the main reasons not to do this and why we generally steer you guys away from that. So obviously there's a couple of other options here. I mean, if you get a lump sum of money, it's easy for all of us to start burning a hole in our pocket and want to spend that money in other ways that may not be most beneficial for us in our retirement years. Maybe you've not planned for inflation and your budget in retirement, so your income could run out shorter. So
I was just hoping to kind of interject here on this, because I think this is really an important one, and this is probably one of the biggest areas of, quite frankly, abuse out there that we see towards educators and their retirement savings, is this concept of taking the money out of the system and investing it, and that whole deal. If you really think about, and I get it, like at some point when you go to retire and you get your packet and they say, hey, you have the option to take 100,000, 150,000, 200,000, 250, whatever it is, and you can check a box, and then that money will end up in your savings account, versus getting, a lifetime payment of 3,000, 4,000, 5,000, 6, whatever it is. I understand that can be tempting, but you really got to do the math, and if you understand it, really what that opportunity is coming out of the pension system of lifetime income. And ultimately, that's kind of what we're working for towards our retirement years. But even looking back at our example, if you were going to be that individual that got paid $41,400 a year through the pension system for the rest of your life, and you worked from age 60 to age 90, then the pension system is going to pay you out about $1 million over that time span. So, the way that you win in the TRS system is you live as long as you can, because if you're living, they keep paying. So just be really mindful of that before you decide to take money out.
thank you, Matt. So our next slide here is going to be on, as you can see, excessive fees. So we've already talked about this a little bit, and we won't go through every single one of these, but fees are something very important for you to look out for, especially in the educator retirement space. So we're going to go through an example of how fees can affect you. However, used to in the past, fee structure was pretty simple, and it would just be a flat, 2, 3, or 4%. However, participants like yourselves did not like that because that seemed real excessive. So after that, all these fees started to get broken down into all these other little names as expense deduction, wrap account fee, custodial fee, just to name a few. And there's also 12B1 fees, withdrawal charges, mortality expense fees. There's a ton of fees that could be applicable to your retirement plan. So don't be afraid to ask whoever you're working with, hey, what are the fees that I'm paying here? And if they tell you no fees, another good question to ask, well, what are you getting paid for this? Because if they're getting paid something, there's fees coming out somewhere. So that's another red flag. If they can't explain those fees to you in a very clear manner, chances are there's hidden fees there that you don't know about. And this is why that's important. So right here we have the fee effect. This illustration is based on someone who earns 6% annually with a $200 monthly contribution for 20 years. So as you can see, if you do this for 20 years and you're charged 1%, your account balance is $82,549. However, just 1% increase is a $9,000 deduction over that time frame. Now, I'm not telling you to choose the absolute lowest fee out there. Some of you are going to want to work with an advisor. You're going to want someone to choose and manage those investments for you, and that's absolutely okay, appropriate, and should be done. However, what you want to know is that advisor or that person or your brother-in-law that's managing your money, are they worth that extra amount? Are they really providing that value to your account and to your finances and to your financial plan that's getting you that? So as you can see, some of these look kind of excessive all the way down to 6%. However, some of the plans with all those different fees they have in there are as high as 3, 4, 4.5% when you start adding on lots of different fees in there, and a lot of those can be hidden. So our next topic is probably the hottest topic in the education space, which is going to be on Social Security, and I'm going to turn that over to Matt.
Great. I know my audio kind of got strange there for a moment. Can you hear me okay, Justin?
Yes.
Okay, great. So Social Security is definitely a hot topic. We probably get the most questions about Social Security when we're out interacting with folks, and for good reason. It can be fairly complex and difficult to understand. But what we want to do is kind of run over this at a high level so you understand how these concepts work. One of the biggest things we get is the misconception that because I have Social Security, somehow my TRS annuity is going to be affected by that. But it's not. It's actually the opposite of that. Is because you have a TRS pension, is your Social Security may be reduced. So take the Social Security, the TRS pension off the table. That's not being affected. However, your Social Security payment, whether it's from your spousal benefit or your own, may be affected. So there's two things that we really want to consider here, these two regulations, and kind of start as a baseline. It's important to understand the foundational part of, as an individual, you are potentially eligible for a Social Security benefit from two sources. Either that from your own personal work experience, and because you did the time of working and you got those 40 credits, and with that, what we'll do is we'll explore the Windfall elimination provision. The other place where you might get Social Security benefit is because of a spousal benefit. So you've been married to your spouse for at least 10 years. And because of that, you are eligible for a spousal Social Security benefit. And because of your TRS pension, we'll have to walk through the government pension offset to figure out if that's going to be reduced or eliminated at all. But we will walk through both of these items. So first, we'll start with the government pension offset, and this one deals with your spousal benefit. This is what I have found is that if you're somebody that potentially has eligible for both, that you are eligible for your own personal Social Security benefit, but you're also married to somebody and potentially eligible for a spousal Social Security benefit, is I find that the government pension offset on the spousal benefit tends to be a bit more punitive, if you will, and you're generally better off if you're eligible for your own benefit or taking that. And you're about to see why as we walk through some of these examples. It's quite simple math, the way the government pension offset works. We simply use what we call the 2/3 rule. All you need to do is take 2/3 of your TRS pension amount and subtract it by your eligible Social Security amount. Okay, and I have some examples for you here. So on the left-hand side, we have somebody that's going to get a TRS pension of $2,100. They're eligible for a spousal Social Security benefit of $1,000. Well, 2/3 of our TRS pension is of 2,100. 2/3 of 2,100 is 1,400. We subtract that from our spousal Social Security benefit, and in this case, the number comes out negative. So this individual would not be eligible to take their spousal Social Security benefit once they take their TRS pension of $2,100. On the right-hand side, I have an example where the math kind of works. Similar situation, the person has a TRS pension of $2,100. They're eligible for a spousal Social Security benefit of $1,600. 2/3 of 2,100 is still 1,400, and we subtract that now from the spousal Social Security benefit of 1,600. That gives us a positive number, a positive 200. So on the right-hand side, this individual would get $2,100 from TRS, because we talked about the TRS pension not being affected, but they would only get $200 as a spousal Social Security benefit. So, again, I know that this is pretty punitive, and I know there's a lot of folks that have had a full career in education and in TRS and have not paid into Social Security, therefore do not qualify for their own, but they should through their spouse. It's walking through these numbers and doing this kind of planning ahead, and knowing when you're going to take your pension, knowing when you're going to try to take a spousal benefit is really important. It's also important to point out that none of this happens, whether when we're talking about the government pension offset or the windfall elimination provision, which will be next. None of this happens, none of these things occur until you start taking your TRS pension. Okay, so you could be eligible for I'll give you a real world example. My family are both educators. My parents were married for more than 10 years and have since been divorced. Well, my mom was eligible while she was still working in education, was able to take her spousal Social Security benefit, even though she was divorced and not remarried, and be able to work her job, take her spousal Social Security benefit. It wasn't until she actually retired and got her TRS pension that her spousal Social Security benefit was eliminated. So keep that in mind, that none of this stuff happens until you start drawing the pension. Under the next one's the windfall elimination provision, and this one again is about our own personal Social Security benefit. When we were talking about TRS, we were really concerned about years of service because that's what went into the formula. When it comes to Social Security, we're worried about years of substantial earnings, and this is a different type of threshold. When it comes to Social Security, there's really two thresholds that we're looking at when we're talking about earnings. One is there is your ability to earn a credit. You can earn 4 credits into Social Security a year. You only need to make $1,410 to earn a credit. So you have to make $5,640 to earn 4 credits within a year. So that's a pretty low threshold in order for you to earn credits. And credits are what qualify you to get a Social Security benefit altogether. So you need 40 credits in order to even qualify for getting a Social Security benefit. Now, having that year count as a year of substantial earnings is a much higher threshold that we'll discuss here. If you haven't seen your Social Security statement in a while, it looks something like this. You'll see the year that you worked, and then down the middle column, you'll see your tax Social Security earnings for that year. So this is really important. So you want to get your Social Security statement in hand. And if you're somebody that's been a career educator, you may see a lot of zeros down the middle there. So just be prepared for that. So the first thing you need to do in preparation for this is to get your Social Security statement. The next thing you do is do a quick Google search of the windfall elimination provision. Usually the first 1 or 2 things that pops up is a 2-page PDF that talks about the windfall elimination provision, but you're looking for basically a chart that looks like what I have on the screen. That's usually on the bottom of the second page. Once you have that chart, what you're seeing is a year followed by basically the substantial earnings threshold for that given year. So in 2020, somebody would have to make over $25,575 in Social Security covered earnings in order for that year to count as a year of substantial earnings. So what we do is we take our Social Security statement and this chart and we put them side by side and we start comparing year by year. For every year that our Social Security statement says we made more than the corresponding year on this chart, we count that as a year of substantial earnings, circle it, highlight it, check it, and go on to the next year. We do that year by year. Once we're done, we tally up all of our check marks and we figure out how many years of substantial earnings that we have. Once we have that number, we compare it to the chart over there on the right-hand side. And let's just say I went through and I found out that I had 25 years of substantial earnings. Well, the chart on the right-hand side would say, it says 65%. Now, I don't want you to think that it's going to be 65% of whatever your Social Security statement says. It's actually going to be better than that, and we'll get to how that works. But 65% is basically becomes the percentage that goes into the first tier of the Social Security formula. And I have an example here for you, hopefully to make this as least complicated as possible. The other question I typically get is, well, if I look at 30 or more, I'm only getting 90%. Well, that's not fair. Well, in Social Security, the formula, 90% is 100%. So that's the standard percentage on the first tier of the formula. The other thing I like to point out is down towards the bottom is, 20% or less. There's a missing number there. It should be 40%. But so if I have 20 years or less, and less could be zero. I could have 40 credits in Social Security, but zero, none of those years are years of substantial earnings. Well, I'm still going to have that 40% as the factor that goes into the to the TRS, the Social Security formula. So I always get this question where people say, well, is it really worth it for me to get, I have 37 credits. Is it worth it for me to get 3 more? I would say that a reduced something is better than 100% of nothing, right? So even if you have 0 years of substantial earnings, you may get a reduced something as opposed to 100% of nothing. So think of that as another planning point. So here's just a quick example of how that all works. This person has a annual index monthly earnings of $1,500 from Social Security, and this person has 20 years of substantial earnings. So we know from our chart, 20 or less means 40% is the percentage that we're going to use. On the left-hand side, I'm going to use the regular formula, assuming we were going to get Social Security without applying the windfall elimination provision. So in 2020, it's 90% of the first $960, then 32% of the amount from $960 to $5,785, and then 15% over $5,785. The percentages do not change, but the dollar amounts do index from year to year. So we total that all up. My Social Security income should be $1,036.80. Okay. Now on the right-hand side, we're actually going to apply the windfall elimination provision to see how that works. So now we've applied the windfall elimination provision because we had 20 years of substantial earnings. We are now, as you can see, we're replacing that 90% on the first tier of the formula with 40% on the first year on the first tier of the formula, and then doing the math again. After we do the math, we see we went from 1,036.80 down to 556.80, and we can see that in fact it was not a 40% reduction. It was actually a lot better than that. It's closer to 50%. So it's actually going to be a better situation than you might think. Here's just kind of a really quick, simple table to help you figure out what you are potentially going to get reduced. And again, this changes annually, but for 2020, if you're retiring, we can see that over on the left-hand side, that if I had 20 years or fewer, 40% would be the first factor in the formula, and we did that. And the maximum dollar amount that could be reduced out of my Social Security is $480. So if we went back to this slide and we subtracted the difference between the totals of on the bottom, we would see the difference there is $480, as this chart then says. So this chart is really helpful because then it gives us a baseline of what to expect on how much is the maximum we could be reduced by the windfall elimination provision, pertaining to how many years of substantial earnings that we have in Social Security. So to kind of wrap things up here, I like to give everybody just 4 quick action items that you can do, over the weekend if you wanted to. tonight if you had time, just to kind of get your financial house in a little bit of order. First and foremost, write down your goals. Know how much they cost. That could be your retirement income goals. How much do I need to have in my bank account every month coming from my retirement savings, my pension, my Social Security, all that stuff. Do I want to travel? Do I want a second home? Do I have other goals that I might have? Well, these all cost money, and we can plan for them and start saving for them now. Know your projections. Go to My TRS, go to Social Security, SSA.gov, and register your accounts and get yourself a baseline estimate of what are you already going to get from these systems, and then that'll help you figure out how much should I be saving on my own in order to get to the income goal that I need. Identify cash flow issues. Develop a budget is huge. We're huge on budgeting over here. If you're having problems having enough money to put towards future goals and you're not budgeting, then you're gonna continue to struggle. The process of budgeting can be very eye-opening to the money that's coming in, but really especially the money that's going out. And you may not realize how much money you're spending on, eating out or entertainment or, gasoline or whatever it might be. Budgeting can help you identify areas where you can cut back. Public service loan forgiveness as a way to free up cash flow as well. And then finally, address your current your saving strategy. Should I be in 403B? Should I be 457? Which one's right for me? Is my investment allocation, are my investments inside of these accounts appropriate for where I'm at? If I'm young, am I being aggressive enough to reach these goals? If I'm closer to retirement, am I conservative enough to protect the money that I've accumulated? So please keep these things in mind. And of course, we're here to help you along the way. We know that times are hard with the pandemic and social distancing and everything like that. So we've set up the TeleWealth virtual consultation system to where we can get you in touch with a financial professional. Justin does this daily, just on the phone or on Zoom with folks. Really easy to schedule a time by going to tcgservices.com/firstmark. You'll see an icon on the right-hand side, which allows you to pick the day and time that's convenient for you. And then that meeting typically takes around 30 minutes for that initial consultation to figure out how we can be of service to you. And again, that can be a phone call, that can be on a Zoom or a Google Meets platform, whichever one is it works out best for you. As we kind of wrap it up here, I really appreciate Justin being on the presentation. We appreciate the partnership with FirstMark and Greg being on the presentation as well. We know there's a lot of content that we covered, and we'd be happy to answer any questions that the group has submitted. Ray, is there anything that we can answer?
Yeah, Matt and Justin, thank you guys so much for that content. I think it's been very, very helpful for folks. There are a few questions, and I do also want to make the comment that if you guys still have questions, to please utilize that Q&A icon in your window and submit them there. This first one, Justin, I think you can answer. The question says, if you spend the last 5 years with a school district that pays into Social Security, are you exempt from the GPO?
So this is a great question, and the answer is yes. If you spend your last 5 years at a district that pays into Social Security and the TRS system, but they're paying into Social Security, you are exempt from that government pension offset. So remember that the government pension offset has to do with the spousal benefit. So when Matt did that calculation of decreasing it by 2/3, if you complete your last 5 years or 60 months at a district that pays into both, you are exempt from that, and you can get your full spousal benefit.
Yeah, and I'll just piggyback on saying that there's, I know San Antonio ISD.
Hey, Matt, sorry, I think your mic might be doing that funky thing again. You want to try again?
Is that better?
Much better, yes.
Okay. Yeah, I know that San Antonio ISD, Austin ISD, there's not many ISDs that also pay into Social Security, pay into TRS and Social Security. But if you're working for one of those employers, again, for your last 60 months, then you will be exempt from the government pension offset.
Excellent. Guys, another question says, how can you access your TRS statement?
That's a great question, Ray, and I can take that one. So your TRS statement is sent out every year. However, you can get it anytime by visiting the website trs.texas.gov. Once you get there, up in the top right-hand corner, there's an option for you to log in or create an account, register for an account. It takes about 5 or so minutes. Once you do that, it will pull up your statement. You'll be able to see your tier, your salaries, whether it's 3 or 5, the average, so that you can do your calculations.
Awesome, Justin. Thank you. There's another question that says, what happens to my retirement plans if I leave my school district and go work in a non-government company?
Yeah, I'll take that one. So, once you separate from employment, you have several options of what you can do with that money. The first few are kind of across the board, and it kind of depends on going back to Justin's part about these different retirement plans that you might have. But generally speaking, across the board, you'll always have the option to either potentially leave the money with the current investment provider that you're with. There's that option if the plan allows for it. And most school district plans do allow you to leave the money in the plan if you want to. The next option would be to basically roll your money over to the retirement plan being provided by your new employer. So if it's a school district, a 403B or a 457, or if you go to the private sector, a 401k plan. So moving it over into your next employer's plan, retirement plan. The third option you have is to potentially roll that money out into an IRA, and basically taking it out of the employer. I'm going to use jargon here, the employer sponsored, but basically a plan tied to your employer, and putting it into an IRA at any bank, credit union, like Firstmark, any financial institution that offers an IRA, and you can park that money there. So it kind of opens up those options. I'll say the fourth one that really only applies to if you're somebody that's in the 457. But if you have a 457 and you're under the age of 59 and a half, you also have the option of taking it as income without the 10% penalty. You would still pay any taxes that you owe, but because it's a 457 plan, and Justin did a really good job at covering, this really distinct difference on 457s that make it unique, is that you would not have to pay that 10% penalty.
Awesome, Matt. Thank you. I know we're a little bit over on time, so I'll take just one more question. And by the way, there was a question that came in if we're going to mail this presentation. Yes, we are going to mail this presentation to you guys very, very soon. But the last question, Matt, that we'll take says, if you have worked at a school that paid into Social Security, does the windfall elimination apply?
Yeah, the answer to that is yes. The windfall elimination does apply across the board, no matter where you worked. But the point is that it shouldn't be an issue. Like, you should still go through that same exercise. But because you've been paying into Social Security, chances are you've made more than that year of substantial earning threshold. So you would still have to go through that exercise. But again, chances are all those years where you're working at a Social Security covered school district, you are exceeding that year of substantial earning threshold.
Awesome, Matt. Well, thank you. There's a few more questions that came through and are a little bit more complicated. So we're going to follow up via those via email. But Matt, Justin, thank you guys for answering the Q&A.
Absolutely. Again, we just want to thank everybody for being a part of the presentation. We hope you found some good information here. Again, thank you to Greg. Thank you to Justin for partnering with us on this presentation. The folks at Firstmark are incredible. If you'd like to follow up, of course, you can use the link to schedule a time with one of our advisors. If you want to just shoot in a phone call, we have our advisor hotline listed for you up here. If you'd like to submit a question by email, you're welcome to do that on the contact information here listed on the screen.
Great. Thank you, everybody, for attending.
Thank you, everyone.